Goods and services tax. What are goods? Pen, pencil, rubber, car, fan, light. Any tangible thing that we can use is a good or called goods. What is a service? Intangible things that we offer, like cleaning service. If you are cleaning the glass, that's a service. If you are transporting goods from one place to another, that is transport service. If you are providing legal service, if you are providing legal advice, that is a legal service. So services are not goods, but they are something that you offer to the client in return for money. So goods and services tax is the tax that we need to pay to the government when you buy or when you sell or buy goods, or when you offer or receive services. This is called goods and service tax. Now earlier we had two kinds of taxes. The one is direct tax. The one is direct tax and the another is indirect tax. Direct tax is something which an individual, he is an individual and this is an institution. So whenever somebody is paying tax to the government directly, it could be either individual or an institution. Like for example, ICICI Bank is an institution. So every year they earn a profit. For the earned profit, they are supposed to pay tax to the government. They will pay this tax as corporate tax directly to the government. So that is a direct tax. That is called corporate tax. Likewise, an individual, suppose he is salaried, so he gets his salary. On the salary, he is supposed to pay tax to the government. So this tax he pays directly to the government. So such taxes where an individual or an institution pay money in the form of tax directly to the government, they are called direct taxes. Such taxes are income tax, wealth tax, corporate tax, capital gains tax. These are some of the direct taxes. You don't have to remember them from the point of view of exam, but you should be aware that there are certain taxes that are paid directly into the government account. These are called direct taxes. Now another kind of taxes, these are called indirect taxes. These indirect taxes are of several kinds. They are listed here. Excise duty, the tax that is paid on liquor is called excise duty. The tax that is paid on import and export of goods is called customs duty. The tax that is paid on any services offered or consumed, they are called service tax. The tax imposed by various states. There are 28 states in India. Each state has got its own tax regime. So there are different kinds of state VAT taxes. Then there is central sales tax, luxury tax, entertainment. So there are so many indirect taxes that were prevalent earlier. Now what are these? Why do we call them as indirect taxes? Unlike the previous tax where the individual or an institution paid directly to the government, in case of indirect tax, the same individual and institution, for example, this individual, if he is selling some goods in the market to this person, so he will collect tax from him. If he is selling services to an institution, he will collect tax for that. Likewise, an institution he is selling something to an individual in the market, he will collect tax. He is offering some service to an institution, he will collect tax. So, in case of indirect taxes, individual or an institution, they collect tax from individuals or institutions in the market whenever they sell goods or offer services, or whenever they purchase goods or consume services. They either pay taxes or they collect taxes. So these taxes that are collected from the market, it is the responsibility of the individual or institution to eventually pay these collected taxes to the government, because these are not directly paid by the consumer to the government, somebody else is paying. These are called indirect taxes. Hope you are clear. So there are two kinds of taxes: direct tax, where the individual or institution they pay directly to the government; indirect tax, somebody else will collect tax on behalf of government, and they are eventually supposed to pay to the government. So these are called indirect taxes. Now we need to focus on indirect taxes. Whatever the GST has been imposed recently, that has replaced these indirect taxes. So GST, goods and services taxes, have replaced indirect taxes. So far so clear? Okay. So these goods and services taxes that has replaced indirect taxes, although it has been streamlined. Earlier it was complete chaos. There were so many different kinds of taxes, so many different states. So one state has one rule, another state has another rule. So it was like a complex system, and it was very difficult to compute the liability of an individual or an institution, what he is supposed to pay tax as tax to the government. So it was very uh, I would say cumbersome procedure, and the tax regime was very complex and difficult to understand. So to simplify all this, central government has imposed goods and services tax recently. Now under goods and services tax, still there are certain taxes that do not fall under the purview of goods and services tax. These are, because such questions can appear in MCQs. You should be aware of these nitty-gritties, like what taxes are not included in GST. This could be one question. So here I have listed down these taxes. Taxes that are not under GST. See, the basic customs duty, like whenever we import goods from abroad or we export goods to abroad, there is customs duty. Basic customs duty is still outside the purview of GST. Then road tax, you must have gone out of station in your car, so you must be paying some toll tax, road tax. So this doesn't come under GST. Then stamp duty, you must have seen some stamp paper. So whenever we buy some property or we enter into an agreement, so we buy stamp papers, that is called stamp duty. It need not be always in the form of stamp paper. They also call it as franking. So we pay certain money to the government as a stamp duty. So that stamp duty also doesn't fall under GST. Then property tax, whenever property is bought or sold, a certain percentage of tax has to be paid. That property tax is not under GST. Toll tax we have already discussed. Then entertainment tax, so the tax that is collected while you are watching a movie, those come under entertainment tax. Electricity duty, so whatever electricity consumption we are doing at home or in institutions, there is a tax element there that doesn't come under GST. Then the excise duty on liquor, still liquor, that is excise duty on the sale of liquor, it doesn't come under GST. And likewise even the petrol, the petroleum the tax collected on at petrol bunks, they don't come under the purview of goods and sales tax. So these are bunch of um taxes that do not fall under the purview of goods and sales tax. See, why I listed them here is there could be an MCQ on this. Which of the following taxes do not fall under GST? So they might petroleum could be one option. So we never know where the MCQ will come from. So such things, although insignificant, it is always better to be aware. Let's move further. I hope you are able to see uh, our beautiful country, India. So, um, India has got 28 states and 8 union territories. So, this GST that we are talking about applies to all the states and union territories. Let us go into details later on. But first of all, who has to pay goods and services tax? So, the government has come with a rule. See, any person whose turnover per year is above 20 lakhs, they are supposed to pay GST to government. So, what is turnover? Turnover is the value of amount of business that you churn during a year. It is not profit. Suppose I am selling goods worth 19 lakhs. So my turnover is 19, but my profit could be just 1 lakh out of that 19. So turnover is the revenue that is generated from your business. So any person or an institution whose annual turnover is more than 20 lakhs, they are supposed to pay goods and services tax. Now this threshold of 20 lakhs is reduced to 10 lakhs in mountainous regions. Why mountainous regions the threshold is less? In the mountainous regions, the development is less. So economy is not so good as other regions. So these are like the northeast and the foothills of Himalayas. So the states like Himachal Pradesh, Uttarakhand, then in the northeast, all the seven sister states, Arunachal Pradesh, Assam, Manipur, Meghalaya, Mizoram, Nagaland, Sikkim, all these mountainous regions, they have a lesser threshold. So in these regions, a person or an institution that does a turnover greater than 10 lakhs need to file GST or need to pay goods and services tax. Let's move further. See, in the goods and services tax, it is very important to pay attention to the terminology that is being used, or else you will get confused. So, can you see on the screen the flow direction? So, here, if you see the goods, here, if you see the goods and services, suppose they are moving in this direction. That means somebody is selling the goods or somebody is offering services. So if they are moving in this direction, in which direction will the payment move or the money move? In the opposite direction. So here it is the like seller or service provider. But here it is the buyer or service consumer. Okay. So money or the payment flows in opposite direction of the goods and services. This you should keep it in your mind. Now, if you see the adjacent box, incoming goods or services. So, in whichever direction the goods and services are moving, that you should note always to determine whether the GST is input GST or output GST. See, there are two kinds of GST from the perspective of an taxpayer. Suppose I am a taxpayer. I have input GST and I have output GST. So what is input GST and output GST? We will discuss this. So suppose I am buying some goods and services. Goods and services are coming to me. Okay. So this is input GST. So when goods and services are coming to me, my money is going out. Okay. So input GST means money is going out. Okay. So if I am selling or offering services, so my money is coming in. So if you see this box, so input GST is in the direction of flow of goods and services. Output GST is in the direction of flow of goods and services. So whichever direction they are moving, from a perspective of taxpayer, if the goods are moving out from me, it is my output GST. If the goods and services are moving in towards me, it is input GST. So whenever, in whichever direction the goods and services are moving, payment will move in the opposite direction. This you should remember. And this determines whether a GST that is paid is input GST or output GST. Okay, this is very important. This is very important to determine a GST whether it is input or output from a taxpayer's perspective. We should look at in which way from his perspective the goods and services are moving. If the goods and services are moving out, it is output GST for him. If the goods and services are moving in, it is called input GST for him. So if there is an input GST is also called input tax credit. If I am a taxpayer and I am consuming some goods and services, so the goods and services are coming to me, so this is input GST for me. This is input tax credit. Okay. So this input tax credit I have already paid to the government. Because I am consuming some goods or services, I will pay to the seller or service provider. Then I will consume the goods or services. So I have paid to the other person. He is supposed to pay to the government. So he will give me an invoice, tax invoice saying I have paid him. That is called input tax credit. So this input tax credit will stand against my name and I can claim it later on, or I can set it off. Understand? So suppose now I am selling goods or offering services. That means goods and services are moving out. Okay, so that is output GST for me. So output GST means money will flow in opposite direction. So I am collecting money from the other person. So I am supposed to pay tax to the government. So output GST, I have collected tax on behalf of government and I am supposed to pay to the government in future. Input GST means I have paid tax to the other person and I need to claim that input GST, which is also called input tax credit. I need to set it off with my output GST. So from a taxpayer's perspective, input GST, output GST both exist. Input GST is also called ITC, which is the amount paid by the taxpayer already, and he is supposed to claim it from the government. Output GST he has collected from the market, but he is supposed to pay to the government. So before paying the output GST to the government, he will set it off with input GST. So this balancing of input and output, so output GST minus input GST, so this will be called balance tax liability. This the taxpayer has to pay to the government. So that is his liability. Did you understand? Clear? Now here comes the important concept in goods and services tax. Goods and services tax is called as value added tax. What does this mean? This means in goods and services tax regime, you are paying tax only on the value addition. Let us see this example, then you will understand it thoroughly. If you see in the picture, manufacturer, wholesaler, see the goods move from manufacturer to the wholesaler, from wholesaler retailers purchase them, and from retailer end consumer will purchase them. Okay, this is the flow of goods. So manufacturer to wholesaler to retailer to consumer. Now look at the left side. Look at this side. Okay, pay attention here. Now manufacturer, suppose the cost of goods is 90 rupees and he intends to have a profit of 10 rupees. So 90 plus 10, 100 rupees is the MRP. He has marked the goods with MRP of 100 rupees. Now on this, suppose 10% is the tax that needs to be paid. So he will pay 10 rupees on this 100, so it comes to 110. So when a wholesaler buys these goods from manufacturer, he will pay 110 rupees. Now 110 rupees will be the cost for the wholesaler. He intends to earn a profit of 10 rupees. So his MRP becomes 120 rupees. Then he needs to pay a tax of 10% on it, which is 12 rupees. So the total price works out to 132. So this is the price 132 which is paid by the retailer to the wholesaler to buy these goods. Now for the retailer, 132 is his cost price. He wants to earn a profit of another 10 rupees. So he changes the market price to 142. And on 142, he is supposed to pay 10% tax, that is 14 rupees 20 paise. And the total cost works out to 156.20. This is the price which the end consumer pays to buy the goods. So in this previous tax regime, so the total price of the goods when it reaches to the customer is 156, and the total taxes paid at each stage, that is 10 rupees here, 12 rupees here, 14.2 here, so totally 36 rupees 20 paisa has been paid as total tax in the old tax regime. Now focus on the right side, this side. The same case. See, the cost of the goods is 90 rupees and 10 rupees the intended profit by the manufacturer. So he marks the goods as 100 rupees MRP. Then 10% is the GST. So 100 plus 10, 110 will be the price that wholesaler will pay to buy these goods. Okay. Now this 110 is the MRP. So here 100, see in case of GST, the MRP keeps on changing. It is the same here also, but here if you see 100 rupees was previous MRP. Now the wholesaler wishes to earn another 10 rupees as his profit. So he will add 10 rupees to this 100. So the new MRP is 110. On this 110, he has to pay 10% GST. So 10% of 110 is 11. So the total price works out to 121. That means the retailer has paid 121 to buy the goods. So now from the consumer perspective, for the retailer, his cost price is 110 rupees. He intends to uh, earn a profit of 10. So he marks the MRP as 120. And then he pays a price of 10% GST, that is 12 rupees. So the total price works out to 132. So here if you see, the consumer is paying 132 to buy the same goods in this new GST regime. So if you compare with earlier, it was 156.2 and here it is 132. So what happened to the end price of the product? It has come down. Why has it come down? If you see here, now concentrate on this output GST, input GST and the tax paid. See, we know that output, as I told you, output GST, input GST. So if you see the flow of goods, then you can determine whether it's output GST or input GST. See, for manufacturer, the goods are flowing out. So whatever tax he is paying is output GST. For him, no goods are being purchased. So for his input GST is 0. Now his tax liability is output GST minus input GST. 10 minus 0 is 10. So the manufacturer has paid 10 rupees, has collected, or rather he has collected 10 rupees from wholesaler as tax on these goods. Now for wholesaler, he has paid 11 rupees as output GST. For him, when the goods are moving out, okay, so he has collected 11 rupees. But when the goods are moving in, when he purchased the goods from the manufacturer, he has paid 10 rupees. So for him, input GST is 10, output GST is 11. So he has paid 1 rupee ultimately as tax. Okay. So although it appears that manufacturer has paid 10 rupees to the government, he has got 10 rupees, he has got 10 rupees from wholesaler. So whatever 10 rupees he has paid, wholesaler has paid actually. He didn't pay anything. He collected from wholesaler and deposited. Likewise, when the retailer has bought from wholesaler, his output GST is 12 rupees that he has paid and his input GST is 11 rupees. So he is only paying 1 rupee. If you see, the total tax that is being paid is 10, 1 and 1, 12 rupees. This total 12 rupees trickles down to the customer. These people, although they have paid, but they will get it back from their next purchaser. That means 10 rupees that he has paid he will get it from wholesaler. The wholesaler 1 rupee what he has paid, he will get it from here, and this 1 rupee whatever he has paid, he will get it from the consumer. So in the end, eventually the consumer is paying the 12 rupees tax that is being paid on the goods totally. So if you compare the taxes, here the tax paid is 36.2 in the previous regime, whereas in GST it is 12 rupees. So where is tax less? GST. So what will that mean? The goods price will go down. That is, goods will become cheaper. Is it good for the consumer? Yes. Is it good for the manufacturer, then wholesaler, retailer? Yes, it is good for everyone. Why? The purchasing power of the consumer goes high, because if he has more money to buy more goods, market demand will increase. So when the taxes are reduced, it is good for everyone. Okay. So here if you see, this 1 rupee tax is paid on whatever profit he want the wholesaler wanted to earn. So this 1 rupee is 10% of the value addition that is added to the goods. So he wanted to earn a profit of 10 rupees. So that is value addition. So tax is only levied on this value addition. Here again 1 rupee is levied as tax. This is levied as on value addition, that is 10 rupees profit that he intends to earn. So GST is the tax on value addition. Whereas here this is tax on tax. Although they have paid tax, 10 rupees tax, again they will pay 12 rupees, again they will pay 14 rupees. So this is called cascading effect of tax, where tax on tax is paid in previous regime. GST, it is tax is paid only on value addition. So GST is in other terms, GST is called value added tax. So here are the benefits of the GST. See, you don't have to mug up what are the benefits for a customer, what are the benefits for the government, what are the benefits for the trader. See, these things you can mention it in your own words if you have logic in your mind. So what is the logic? Just see. We can, if you have a slight knowledge of economy, you can put the same point in different perspective and in your own words, and it becomes a point there. Okay, but logically it trickles to these benefits of GST. Let us see what they are. If you see for traders, see, it is a simple tax system. Earlier what happened, there were so many taxes. Each state had a different kind of tax regime. So they had complex tax system. If they are selling different types of goods, then another headache. So it was very cumbersome for them to calculate their tax liability, what is to be paid to the government. So for them now, after arrival of GST, it is one tax, one nation. So entire markets in all the states, all union territories, now they behave as one market. So they just need to pay GST, input, output, what is tax level, finish. So this has simplified the tax system for traders. Agreed? Now, the same point when it comes to consumers. So for them, it is a transparent tax. Earlier, they used to, suppose they are buying a product that is manufactured in Bombay, then is coming via Indore from Bangalore to Hyderabad. So they have to calculate VAT of various states at the borders, what they are paying taxes and all this. It was very complex. From the perspective of consumers, it has become a single transparent tax. So they are very clear. If a product costs this much, so much of percentage of GST. Now let us come to various slabs of GST in a short while. But once a GST is fixed, like a certain percentage of GST needs to be paid on a product, once that is fixed, then a customer is very clear, this much of tax I need to pay to the government. Now from the government perspective, when the tax system has been simplified, okay, it is very easy for the government to administer. They earlier they used to keep so many books of records. Now it is simple tax system. For them to administer who is paying and who is not paying, they need to police the tax system. So for them it becomes easy. So this point, if you drill down in your mind, then you can put the same point in various words, applying to different aspects of economy, and come up with 2-3 different points of the same thing. Let us see next. Tax, less tax is levied. We have seen earlier in the previous regime, it was 36.2 rupees that was paid as tax, whereas in GST it was 12. So less tax is levied. Earlier, tax on tax was levied, but now tax is paid on value addition. So whatever value has been added to the product. So At each stage, tax is collected only on that value addition, not tax on tax. There is no cascading effect of tax on tax. So from trader's perspective, it is less tax. Okay, and from consumer's perspective, less tax, which is good for him. So from government perspective, when when it is less tax, more people will come forward to pay tax honestly. So tax compliance will improve, and tax uh, evasion, that is some people who avoid taxes, it will come down. Okay, so when less tax is levied, these things happen. You can put this in different words if you want to come up with other words, other points. Then increase market demand. If you we just saw in the GST regime that the final price of the product was less to the consumer. So that means the product has become cheaper in the market. So from the trader's perspective, their market demand will go high. For example, if a washing machine costs 20,000, there will be less number of buyers. If a washing machine costs just 5,000, there will be double the number of buyers. It could be double the number of buyers. So market demand will improve. So from consumer perspective, when the price of the final product goes down, they have cheaper goods and services. So for example, if I can buy a two-wheeler in 20,000, okay, in previous regime it used to cost me 40,000. So so more number of people will go to buy two-wheelers. In that way, consumers are uh, uh, take the advantage of cheaper goods. So they avail more goods, they avail more services. So from government perspective, when the market demand is high, when the goods and services become cheaper, when more customers are buying, so the revenues of individuals and business entities will go high. So the economy of the government will improve. Economy of the country will improve. So from government perspective, they will generate higher revenues. So more tax is actually collected, although less less rate of tax is levied. The quantum of tax collected at the end of each financial year could exceed what was being collected earlier. Okay, so from government perspective, higher revenues and more improved economy. I hope it is clear. Let us move to the next. Now we understand what is GST. We understand how it is good for all the market players, how it simplifies the tax system, how like it improves um tax compliance, how it reduces tax evasion. All these are clear. Now, what tax needs to be collected on what goods, what sort of goods? This the government will decide. See, the GST is governed by by an authority called GST Council. So this council, they meet on a regular basis to decide the percentage of tax that needs to be levied on different category of goods. So currently there are 5 slabs of GST that are being levied. So if you see the screen here, it is not important to remember which goods fall under which tax slab, but you should know these are the tax slabs that are being levied. So first is 0%, 0, next is 5%, then 12%, then 18%, then 28%. Now, certain goods that are bare necessities, they fall, the government has decided that they will not collect any tax on them. So they fall under 0% GST. Bare necessities. Then 5% slab, certain goods that are very essential, they fall under 5%. So the government has decided to help the common man by levying very less tax on such goods which are essential for daily life. Then 12%, these are some intermediaries where they are not essential but important. So they are levied 12%. Now 18%, there are certain luxurious goods. So if these goods, they are levied at 18%. Then there are super luxurious goods. So they are levied 28%. If you are really interested in what kind of goods, so just to give you a sense, for example, milk, salt, jaggery, lassi, coconut water, all these fall under 0% tax slab. Then this agarbatti, cashew nuts, footwear, clothes, milk, all this fall under 5%. Then if you see 12% slab rate, ghee, butter, almonds, pickles, processed food, etc. fall under this. If you see at 18%, mobiles, computers, printers, CCTVs, so these are luxury items, 18%. So if you see at 28%, luxury cars, mobiles. So it is not important to remember um, like what, like which goods fall under which slab, but you need to just remember these are the five slabs. So 0%, 5%, 12%, 18%, and 28%. So these are the five slabs on which five slabs under which various products and services are categorized. Okay, so far so clear. Let's move further. Now on the screen you can see our Pyara Bharat. This is our lovely India. So it has got about 28 states and some 8 union territories. Okay, so if you see this blue arrow, okay, that is from Gujarat to this state. So what I mean to say is the products are moving from this state to here. Okay, Chhattisgarh. Now if you see this red four-way arrow, so these goods are moving within Andhra Pradesh here. Can you see? Like goods are moving within Andhra Pradesh. Here goods are moving within Maharashtra. So here if you see the green four-way arrow, what I try to depict is these goods are moving within Andaman and Nicobar. So within Union Territory. So I tried to show this green four-way arrow to depict movement of goods within Union Territory and red four-way arrow to depict movement of goods within state and the blue curved arrow to depict movement of goods from one state to another. So the blue arrow depicts interstate movement of goods. Clear? Okay. Now, if you see the types of GST, the right side, see there are three entities or payees of the GST. Payer is taxpayer, payee is government. So the authority who are getting paid, they are payee. So there are three kinds of payees. One is central government, state government, UT government. That is Union Territory government. Okay, clear? So now the GSTs are categorized as four kinds of GST. If you see here, you see here, these are the four kind of GST. IGST is called Integrated Goods and Services Tax. This is to be paid to the central government. CGST, Central Goods and Services Tax. This is to be paid to central government. SGST, State Goods and Services Tax. This is to be paid to the respective state government. UGST, this is Union Territory Goods and Services Tax. Again, Union Territories are governed by central government. So although it is called Union Territory, they might even have an assembly for taking political decisions, but the government is run by central government, the President of India. So that is the reason why for Union Territory GST, again central government is the payee. Clear? Now, whenever the goods are moving from one place to another, if you see this, now focus here. Whenever the goods are moving from one place to another, they could be of two types. One is local movement, that is intra-state, like within the state or within the union territory. Okay, that is called local. But if they cross the border of the state or the border of the union territory, then it is called outside the state. So it is termed as interstate. Okay. So the movement of goods could be intrastate or interstate. So first let us see when they move within the state. So what happens? Suppose the tax slab levied on a particular goods is 5% and it is intrastate, within the state. So how is the tax distributed? That 5%, see 5% is the total GST. So out of that 5%, 2.5% should be given to central GST and another 2.5 needs to be given to state GST. Do you understand? Suppose in Telangana, one product is moving within the state and 5% GST needs to be paid. So half of that GST has to be paid to the central government. Let it be the movement of goods within union territory or within a state, among any of the 28 states or among any of the 8 territories. Whenever a GST is paid, half of the GST has to be paid to the central government. Another half will go to the state government or union territory if it is within, if the movement is within the state boundary or within the union territory boundary. So when it is intrastate, we said 5% is the GST levied. So that means 2.5% will go to CGST, central government GST, and another 2.5% to state GST. If it is the case of union territory, then UGST. Understand? Now, come to the other side. When the goods are moving, crossing the boundary, and they are moving interstate, like that is the goods originated from a state and moving to another state, or the goods that originated from a union territory and going to another territory. Now here if it is 5% that is levied, the same case 5% of GST, here the entire 5% is paid as IGST, integrated GST, to the central government. So what we need to remember is whenever the goods are moving interstate, then this entire slab of GST has to be paid to IGST. If the goods are moving intrastate or intra-union territory, then the percentage of GST, half of it has to be paid to the SGST, that is state GST, or union territory GST. Half is to be paid to the state GST or union territory GST. Another half to be paid to the CGST, central GST. Understand? So when we look at examples, numerical examples, this will be very clear. What you need to remember is IGST is integrated goods and services tax. So in multiple choice, they might ask you what does IGST stand for? It is integrated or interstate. So you will get confused. So you should be conscious about the terms. So integrated goods and services tax. CGST central goods and services tax. SGST state goods and services tax. UGST union territory. It is also called UTGST, union territory GST. Sometimes it is called UGST, uh, union territory GST again. Okay. So far so clear. Okay. So we have seen what is GST, uh, how GST benefits can be availed by uh, all the market players. We have seen how it helps our economy. We have seen what are the different slab rates of GST, and we have seen what are the different kinds of GST and how they are levied on when the goods move from one place to another.